I know it's been a minute since my last video. I hope you didn't blow up your account. We're finally back. And if you're new to this channel, I trade a Robinhood account to $1 million and I show you every single step of the way how I get there. And as of Monday, June 22nd, we closed the account at $53,299. We're down $1,700 on the day, and it looks like the market's starting to sell a bit here as well overnight. But over the last month, we are down $283. So things have been pretty sideways in the account, and that's just really due to the fact that the market is starting to consolidate. And a lot of our positions, we've taken some profit on. We're starting to build a bit of more of a cash position, but now we're starting to deploy into other positions as well. And as part of the public portfolios, we also do have the selling options account, which had a $2,400 down day on the week, 438. But over the last month, we're up $1,800. And the total portfolio over the last week is down $2,166, up $2,100 over the last month. And over the last 3 months, we are up $53,477. So portfolio has been doing really well since the March lows. We stayed long and strong, and the market has rewarded us for our conviction. Now things are starting to look a little bit shaky. We're trying to manage some of these positions. Obviously, Nebius has done amazing for us in this account, but we are starting to see a bit of a pullback on Amazon as well as silver, as well as ServiceNow. HIMS is starting to rally. So there's a bit of a mixed bag going on in the overall market. So I want to cover real briefly what the overall index looks like and where I think things are headed, because obviously that's going to set the stage for everything else in the portfolio. So right now we are starting to form a bit of a consolidation. If we draw the upper trend line here, as well as add it to the lower wick that we had here down to 722 on SPY, it looks like we might be forming a bit of a consolidation here. We had a nice run from March lows. This was 20% to the upside. Now we're starting to consolidate a little bit here. This was mostly driven by AI, artificial intelligence stocks. Now we're starting to see a bit of maybe a flag playing out. And obviously we're in the upper middle area of this range. So it's certainly possible we could have a move lower to like 720, fill in some of these lower volume shelves that remain open. We could even come all the way back down and retest the previous highs at 700. I don't think that is necessarily going to happen, but I'm definitely being very cautious in the public accounts as well as my personal account, because I don't know exactly where things are going to go. And we just had a very strong run, made a lot of money, and now we're trying to safeguard that money, let everybody else try to chase here while, everyone's kind of shuffling the deck, playing musical chairs. And then we'll see if, we can time a bit of a bottom here and start pushing higher. So really the strategy right now, of course, we have this gap here. Maybe this gap will fill. We could push back down to 738 and then maybe even push lower. Maybe we'll hold this gap and start to push higher here and test the upper bound of this trend line through this candle and this candle. And maybe we'll just break out here. You could certainly wait and chase for playing the momentum and actually loading up at a higher price at 753, 754. As long as 752 area holds, then we'd start pushing and probably break over 760 on SPY. Or alternatively, you could try to play the lower end of this near 720 on SPY. So that's kind of like where I'm thinking if I was playing the index. But within the index, the actual stocks that I'm playing, I'm usually looking for playing cash secured puts, right? Because if the index falls lower, then the stock that I want to own is also going to most likely drop as well. And using cash secured puts, I can pick the price at which I buy, so which would be lower than the current price, and I can get a sign down there. So this is kind of like a good strategy, right? If you're a little bit bearish, or maybe you think that the market could sell, but you don't want to wait around, you want to start trying to collect premium on cash secured puts. Obviously, if you could time it and there's the sell-off here, then selling cash secured puts, buying shares would be better down there. But this maybe can give you at least a better entry if you're impatient and don't know if it's going to sell off. So I've been selling some cash secured puts on dips on stocks that I really like, maybe buying some leaps, maybe buying some shares. So that's kind of how I've been playing this right now. You could play call debit spreads if you're bullish. on some stocks. That'll at least cut out some of the potential for things to chop sideways, and you're just like chopping the theta decay on your options. I think it's just much better right now to be a little bit on the safer side with your positions and the options that you're choosing. So that's where the overall market is right now. On the calendar, we have GDP as well as PCE and jobless claims on Thursday. That could maybe move the markets. And then next week, we do have the unemployment rate as well as PMI and some other things, right? So there are some things on the calendar to worry about. We also just ended quad witching on June 18th, which was last Thursday. Friday was a holiday. Sometimes you have a bit of a weakness after a quarterly OPEX, which is just a lot of things expiring at once, essentially. But at the end of this month, we also have quarterly rebalancing. So funds are going to be rebalancing, and that could add to some volatility. Right now, VIX is sitting at 17. So this is kind of holding in this like really 16 to 18 range. Of course, we had the higher move to 22, which was a bit more of like a back and forth going on with Iran. They shot down a helicopter, and we saw this spike higher. But now we're starting to see them actually walk back and decide to meet with Iran and Switzerland. They have like a 60-day draft of an agreement for an actual ceasefire, start reopening the strait. Iran is going to be able to sell their oil globally. Obviously, the more oil supply that there is, if there's more supply of oil, then naturally supply and demand prices go down. And so I do think you're already seeing it now. I've been talking about oil returning back, fully retracing this move. You're starting to see this sell-off already start to take place after a lot of people thought this was going to go much higher. We are now starting to see this leak out and push all the way back under $70 a barrel. So I think we're going to see this go even lower over time. At some point, all the fighting that's been going on is going to slow down, reopen the strait. Oil is going to flow, the spice is going to flow, and then, oil is going to go down. And when oil goes down, well, this is driving really all the cost of food and supplies, right? Because you have freight, shipping, everything moving around, the distribution, the logistics, it's all driven off of oil. And as oil goes lower, the cost of things go down. And well, what happens when the cost of energy and oil goes down? Well, inflation also goes down, right? So right now, Bank of America is saying they're going to hike 3 times this year, which is a load of crap. That's definitely not going to happen, because if they did do that, then they would just push us quicker into a recession, which is eventually is what they're going to have to save us from anyway. So they're not going to yo-yo raise rates and then lower rates to try to save it. And of course, they don't even really set the rates anyway. Like yields have been pushing higher over the last several months with the war. Now those are starting to drop. And of course, even with Bank of America saying that they're going to hike rates, that's not actually going to happen. And as inflation, which has been really driven higher in the recent months because oil was trading over 100 a barrel because of the war, inflation is going to more than likely start to head lower once again. And then they'll start saying, oh, disinflation, maybe at some point even deflation, which I do think is going to eventually happen. Right now they're spending all this money, right, with debt, tax cuts, they're doing all these different things, all these investments, and that is also leading and driving inflation. It's also driving up our US debt. Global debt is also just accelerating, right? So this is going to be the real thing that kills us in the end is how much debt is in the system. That's going to lead to all that deflation. And, that's what's really going to eventually cause a massive recession in not only the US, but globally. But I do think here, we're ultimately going to see everybody faked out, right? Right now, the market's a little hesitant. Jobs are still pretty solid. But once inflation starts to drop and the job market's still relatively okay, it's still under 5%, 4.3, job market will slowly start to deteriorate. But people are going to be really focused on the fact that they're lowering rates as well as GDP, as well as these companies' earnings are showing up as being really positive, setting new records. And we're going to see this very strong breakout, right? Because rates are coming down as well as GDP growth is actually accelerating. But underneath the surface, I think eventually that's going to tip over into deflation. And we're going to top out here somewhere in this 840 to 850 range on SPY. And then we're going to have this massive correction, probably like, I can't even zoom out that far on this chart, but I do think we're going to see a massive like 30 to 50% drop that will eventually play out as all the amount of leverage in the system balloons even higher, right? You're seeing right now the Mag 7 stocks, they are being a drag on everything. Even Amazon is not doing well, which is a position in the portfolio. We're starting to see maybe the Mag 7 here is forming a bit of a bear flag that's going to come back down to 62.58, the MAG's ETF. Amazon is round tripping this whole move. I bought here at 230. Now it's back down to 230. Like this could even go lower, right? Like maybe it'll come back and retest this previous trend line at 226, 228. It's right now sitting on the 200-day moving average at 233. So, things are not looking very good for the Mag 7. We're seeing a bit of a rotation going into other stocks. You saw small caps, the Russell making new highs today. But then Qs were down as well as SPY was down, but the Dow was up. So who knows what's going to happen here? Obviously, Amazon is trading at its lowest valuation ever from a price to earnings historical perspective, right? 28 times price to earnings. We're at 234. They're accelerating on AWS. Tranium is also sold out. That's really my thesis on Amazon in the short run. And then, of course, they're going to be a big benefactor of all the AI and robotics and efficiency wave that they're supposed to have. But in the near term, who knows what happens here? So definitely going to be buying a bit more at 226. Definitely going to be buying a bit more at 218 if we can get down into this previous gap that we formed here on the initial news. Weirdly, they actually do a lot better after Prime Day, right? So like, maybe it's on investors' mind, on retail's mind, they start buying more Amazon. If the numbers and consumer spending is strong, that's also very good for Amazon's ecosystem. So right here at the end of June, going into early July, hopefully we can see a bit of a bottom form here. And I don't have a lot of time on some of these contracts going into August. I might even have to diamond hand through the earnings. So I'm really hoping we can get a bit of a move back here to like 257 to 266, and then I can actually manage my positions a lot better. Even like 250 will give me some breathing room on these dead options, but I also have some further dated ones that I'm not too worried about yet. But maybe I'll start manage those and push those out a little bit more if we get like a bigger move in the overall index. Along with a move in Amazon. Some things I'm really excited about, of course, is HIMS, right? We've had this breakout as well as a breakout of these downtrends. HIMS makes these crazy runs, right? Like it's just, for whatever reason, whenever it moves, it really has a strong move. Now we're starting to see this play out. We have peptides. We got Ozempic. We got Novo Nordisk also breaking out of its chart as well. This is breaking out. So we're seeing a lot of really strong moves in healthcare. Peptides is a huge thing right now. Ozempic is like becoming more of a thing. Like this thing is like S-curving even more and proliferating into our society here in America. HIMS had like a big sell-off on earnings. This was like a quality quarter for them because they made all these acquisitions and they're expanding internationally. They partnered with Novo Nordisk back on this initial bounce. And things are starting to come back a bit for HIMS, right? The narrative, the story is starting to change. You're even seeing short interest start to drop. So maybe they're starting to tuck tail and run. But we did break out. I'd really like to see us push towards this lower volume shelf between $38 to $41 a share. That's definitely a good area to be selling covered calls if it gets there ahead of earnings or even before earning, maybe YOLO it through earnings. I think they could have a very strong earnings because of the deal that took place at the end of March. So all of Q2, they're probably going to show a lot of growth there because they were selling the Wegovy pills through the HIMS platform. I just know a lot more people on Ozempic. Like, I don't know what's going on. But nonetheless, I think we can push here into like $40 and then make a move towards 46. If we can recover that, then obviously like 52 to 60 is definitely within play. This could be like a long-term play. Like I think there's a lot of tailwinds for this sector, and a lot of people just only trade on that, right? I think what they're doing with the expansion, as well as, they're partnering with Aura, the Aura Ring, as well as labs, wearables, things like that. They've made a bunch of new hires of like really strong talent in their business. So like all of these things, like I think they're making all the right moves, and we could definitely see a stronger move. Obviously, this is a very risky stock, but I've been buying a lot of shares, as you can see here in the Robinhood account. We bought 100 shares and we sold a HIMS 47 covered call for $3.10. So that's like basically subsidizing the 100 shares that we just bought. I might run this again since we got a lot of cash in the selling options account. But you can see here, like we got 20,000 in options collateral. We sold some more covered calls today because a lot expired. But yeah, very bullish on HIMS overall. And then like, of course, like Microsoft, like Google sold off, like Microsoft selling off. This is below the 200 weekly moving average, which you can see here at 386. Charlie Munger would be rolling over in his grave right now, buying Microsoft since it's under the 200 weekly moving average. But like I said, like the Mag 7 stocks, like maybe money's not rotating there as much anymore. We're going to see things start to play out elsewhere. One thing that I'm really bullish on, which is part of the whole narrative of oil and inflation dropping, which leads to lower yields, things like metal start to perform better because they're non-yielding assets. I think we can have a big run in metals. It's really hard to time right now. If you just look at the chart here, like it's kind of all over the place. It broke out. It had the crazy run. Now it's starting to settle down quite a bit. It could definitely push to the lower end of this. It's kind of forming like a falling wedge, if you will, which is a bullish consolidation. We had some of these breakdowns. I'm really hoping that this area is all just consolidation, and then we're going to start to make another run here, break out from this downtrend and make the move higher once the narrative switches back to lowering rates. And then what about the debt problem, right? There's just so much debt in the system, and people like to flock to silver and gold. They also sell the US dollar. The US dollar has been up in like recent weeks, but yeah, I think this is all going to head lower. I'm betting against the market in a way, thinking that gold and silver are all going to do better and that we're going to have rate cuts, which I think that will eventually play out. So we'll see how that actually, when the market wakes up and decides to actually buy into that. And when that does, I think this is going to re-rate much higher. I'm being very cautious because this is a lot of chop. It's very hard to time this move. There's like a lot of volume in certain areas that have shown up. But the way that I'm looking at this is I'm actually buying some leaps. So I'm buying Silver Miners SILJ, $35 call for 2028. I'll probably add more to this position, which I can show you here. But I'm very bullish, right? Because if all of those things happen, like I said, then we're going to see that re-rate higher, and people are going to start to flock to metals as yields drop. And then, of course, the overall market is going to participate as well. But these are the current position that I added today. 32 calls for January, and then for 2028, 35, and then 32 to 37 debit spreads, which would be like a 4x almost if I actually hit on those by January. But 35 on this is pretty far out the money. So it is very risky, even the 32, but it just recently traded there, right? So we're having a bit of a gap that formed here, and you can also see this on silver, right? So you had a little bit of a gap up. This one's already filled through. There's a gap that remains above on this. For SILJ, this is filling the gap. We could certainly fall a bit lower, so I'm being very cautious because we could retrace back to $24, and I'd be definitely buying more down here in this 24 range. That would be a great entry just because it's on the lower end of this trend line. You'll see some actual buying pressure show up as price likes to react off of these trend lines. But really, of course, the big break here is trying to get through this upper trend line, which we have two reactions on this trend line. So it could flip. I think my longer term target here is definitely like the previous all-time highs at $40 to $41 a share. But I think that this could definitely push much higher towards $50 to even $60 a share if silver has a very strong bull run above previous highs at 120. So, silver is like obviously more leverage than gold, but then having silver miners on silver is even more leverage. And then I'm also playing options. So I'm taking a lot of risk here. It's going to be a smaller size position in the portfolio. Still, the bread and butter here is very much in Nebius, which just made recent highs at 300 a share. MACD is not like supporting this move nearly as much. Of course, they just got added and included into the NASDAQ 100 today. So you had a bit of a pop here on that news. MACD is not as high as this previous high, but that doesn't mean we couldn't keep pushing here and then make a higher high in MACD. So we'll see how things play out. We know Arcadi has recently just said that they are pursuing very special financing, right? Non-traditional financing, which could be very bullish for Nebius because it's a very capital intensive, high CapEx business. So if there's some special financing here, that could be very bullish for the price of Nebius. My target this year still remains at 400, but if things get crazy and squeezy, obviously we could push to $500 to $600 a share later. They had this inflection meeting somewhat recently, which is very bullish for at least from what I saw, right? They're signing up all these enterprise customers as opposed to striking more deals with Microsoft or Meta, these bare metal capacity GPU deals. And you selling directly to enterprises has a higher margin, right? So this is actually could be very bullish for Nebius becoming the go-to AI factory for a lot of enterprises that don't need to use frontier models. And Nebius offers a bunch of open source, much cheaper, as well as they're very focused on squeezing out more tokens per GPU. So very efficient overall. And, Nebius is really executing on what I always believed to be true. And now we're starting to see this play out. So the way that I'm thinking about this is definitely selling some covered calls here just because it got up to 300. Things might pause a bit. Obviously, like earnings are coming up in late July, early August. If it comes back down to like 231 to 240 range, I'm definitely going to be buying maybe some more shares, selling some cash secured puts, maybe some more leaps, because ultimately I still think this company is going to make a much stronger move to 400, maybe even above that. Even longer term, like we got some crazy price targets now by 2030, closer to like over 2,000 a share. I definitely think it can get at least over 1,000 a share. It's still only 71 billion market cap. Even if it got to like 300 billion market cap, that's like a 3 to 5, 6, 7x on your money. So definitely very bullish overall on Nebius going into year end. But you might have some bumps along the way. It's kind of just like staircasing, right? So maybe trying to time it on a pullback, as it's making these higher lows and higher highs, and then just kind of time it here, time it there, time it there. Maybe you'll have a more expansive move at some point. Maybe it might consolidate for a longer period of time. But if you have the conviction and you can hold out, then obviously you're going to benefit on the longer run. And then, just a few other things here. Obviously, they could have total active capacity of 7.5 gigawatts by 2030, which is just massive, right? So you could see all the different locations of capacity and when those actually come online. And, I think Q2 earnings might be a little bit of a shaky ground because margins and the acquisitions they made, it might actually compress margins, even though they talked about it in Q1. So selling some covered calls in August could be definitely smart from a risk perspective. But hopefully price can make a nice push before earnings, and then you start selling like some 420 plus covered calls for like a really nice $10 plus credit, maybe even $20, depending on how much demand there is right now. But yeah, overall, pretty bullish on where things stand. I know the overall market is starting to sell off a bit here. We're in like this pattern, so you just got to be a little bit careful if we kind of flag out here, or if we like go to the lower end of these ranges on the NASDAQ or even on the S&P 500. Like maybe this is just flagging out, but maybe we're also in a bigger consolidation pattern. So just be very careful. We'll see how things go, but I think after June end, depending on how price holds, and if we start to break out of these ranges on the S&P 500 and NASDAQ, then I'm going to be very bullish for another leg higher going into probably like August, September timeframe. And then in September, usually there's some volatility as well. But there's still a lot of fuel in the engine with VIX kind of hovering here in this like 17 to 20 range. So just be a little bit careful. But I hope you enjoyed this video. Make sure you guys like, subscribe, join the Discord. We're finally back. I'm going to be posting a lot more videos. So I hope you enjoyed the content, and I'll see you in the next video, guys. Peace.